For the last 2 decades, the most lucrative strategy on Wall Street relied on a single invisible metric: physical speed. Financial firms spent billions to gain an edge measured in microseconds. They bored perfectly straight tunnels through mountains and laid dedicated cables across the floor of the Atlantic Ocean, all to shave off a fraction of a millisecond from their trade times. This became known as the race to zero. The industry treated physical latency, the raw speed of a signal traveling from point A to point B, as the ultimate metric of success in the market. But this pure speed race can harm regular investors. When ultra-fast traders react to news microseconds before everyone else, it can create a toxic order flow, leaving pension funds and retail buyers to absorb worse prices through adverse selection. The industry's preoccupation with the microsecond shifted investment toward hardware, often at the expense of the predictive models used to value the assets themselves. Alex Girko saw the physical limits of this strategy. A Russian-born mathematical prodigy and former trader at Deutsche Bank, Girko recognized that the hardware speed race was reaching a point of diminishing returns. He made a calculated pivot. Instead of fighting to be the fastest to react to an event that just happened, he decided his algorithms needed to be the smartest at predicting what was about to happen. In 2015, he launched XTX Markets. He built the firm around quantitative intelligence and machine learning, moving away from the traditional reliance on ultra-low latency infrastructure. The modern scale of this approach is significant. With a lean staff of only 250 employees, XTX processes roughly $250 billion in trading volume across global markets every single day. That volume translates directly to the firm's balance sheet, with XTX generating over $3.9 billion in revenue in 2025. XTX demonstrated that a small team focused on mathematical modeling could successfully compete with the largest infrastructure-heavy firms on Wall Street. To understand the firm's success, we have to look at market making. XTX isn't placing massive directional bets on whether a stock rises or falls. Instead, they constantly buy and sell assets, pocketing fractions of a cent millions of times a day by sitting between buyers and sellers. Traditional high-frequency traders survive in this space using physical speed as a defense. They use their microsecond advantage to instantly cancel their orders, right before a money-losing trade can hit them. XTX handles this differently. Instead of fleeing at the last microsecond, they use machine learning to forecast price movements minutes or even hours into the future, allowing them to adjust their pricing based on where the market is headed. This intelligence allows XTX to absorb trades that other firms avoid, providing a more consistent and reliable layer of liquidity to the market. This letter submitted to the SEC highlights XTX's status as a quantitative electronic liquidity provider, processing $250 billion daily. In it, the firm actively urges regulators to support transparent market structures and end the unfair advantages provided by raw physical speed. The success of the trade now depended on the accuracy of the predictive model, making the traditional requirement for physical reflexes a secondary concern. But running predictive AI on this scale requires an immense operational commitment. Building accurate market models involves processing unimaginable amounts of historical and real-time data simultaneously. To handle the load, XTX built a massive proprietary infrastructure, holding 650 petabytes of storage and an in-house computing cluster of over 25,000 NVIDIA GPUs. Many hedge funds rent their computing power from cloud providers. However, for massive-scale financial simulations, cloud computing can create latency and data bottlenecks that slow down the research process. For XTX, owning the hardware and running their own data center in Finland is the advantage. It enables continuous model training that firms relying on rented cloud space struggle to match. Because this hardware-backed blueprint is built on mathematics, it is highly scalable. XTX moved from foreign exchange into equities, commodities, and crypto using the same core processing power. XTX's infrastructure is designed for high-scale computation, treating the ability to process complex models as the firm's primary competitive advantage. The financial payoff of this prediction engine has been substantial. In 2025, XTX posted £1.7 billion in net profit, yielding massive dividend payouts for Girko as the 75% owner. Girko remains an anomaly among the global ultra-wealthy. He actively rejects tax havens and proudly pays his domestic taxes in full. The proof is in the record. Girko became the United Kingdom's highest taxpayer contributing over £664 million to the government in a single year. The remaining profits are designed to fuel a philanthropic loop, pouring capital back into the mathematics and science that built the firm. XTX has committed over £350 million to educational causes, including the $40 million Global Talent Fund and the 1729 Math School for gifted students. They even directly fund pure science research, like the Mothra telescope, mapping the cosmic web of gas and dark matter connecting the universe. XTX Markets demonstrated that when raw speed reaches its limit, mathematical intelligence takes the lead, with its dividends now funding the next generation of human knowledge.